Hey everyone, so I'm gonna try to finish this off right now. So this should be part three and the last part of this series. If you did enjoy this series, please leave a like, leave a comment, let me know what you think about breaking it up like this. I've had some people ask me to have more digestible content. So I'm hoping that this way of doing it's a little bit better. And also I've enjoyed this subject doing this type of a series, which is a little bit more educational. So please let me know if you like it. Anyways, getting to the final part of this series, I wanted to kind of go through, I went through a little bit in the last one about the cycles, where we were at, where I think we're at based on the major model and Martin Pring's model and those people's model. And I think one thing that's interesting that I have pointed to before already is that when Pring talks about this, he's talking about this being in an economic contraction. So, and basically, if you look at fundamentally why these bonds would be the first thing to turn up is most of the time as growth is slowing, bonds are usually going to do well. Inflation is usually dropping because the Fed has either put pressure on it or the market, something has started to put pressure on it. So bonds usually can do well in that environment starting out. Stocks being the next thing to kind of turn up. That's still in a contraction, and that's interesting because most people would say, well, the economy is doing badly. How can this happen? And so, easy way to look at that is going back to something as simple as 2020 and saying, like, when did the market bottom? Did it bottom after we got out of the shutdowns and COVID was cured and we had a vaccine or something? Or did it a market bottom in the middle of the shutdowns and all the crazy global turmoil? Which it did. It bottomed right in the middle of global turmoil. Very normal for that to happen. And then we're looking at another part of it, buy inflation sensitive. So buying something inflation sensitive, meaning energy-based commodities, cyclicals, copper miners, and so on. So when we have kind of all these different things, we can kind of go, okay, well, and commodities as well. So we kind of had this cycle kind of drawn up here and a way to kind of look at it. And then we start to sell as we get into actually the economic expansion. Now it's very hard to time all this, it makes it look, these models make it look very simple to say, oh, well, it's just like this, and you buy and that's the problem with kind of looking at these and going, look, everything's perfect. That's exactly how it's going to work. It's a model, it's something to kind of look at, go off of, and understand, and maybe it can help you understand where we're at the cycle today. And that's where we're going to focus on in this last part, where we're at today. So I went through a couple of these, basically this is when bonds bottomed back in 2018. We had that bottoming part of that cycle. And if you remember, in that point, the economy was kind of falling apart. The Fed was starting to raise rates. All of these things were happening, and bonds started at some point right in the middle of all that to turn up. Bond market kind of calls bluff on things at the moment. So I think that it was very telling. I mentioned it this time as well. It's very telling that this time, especially on Wednesday, that all of a sudden the bond market started to turn up as the Fed was raising rates. Now, bonds are inverse. Study bonds if you don't know them that well, but bonds being inverse means that as rates move up, bond prices usually go the other direction. This is a chart of USB. This is the bond prices 30-year. So basically, bond prices start to turn up and bottom. Market's still kind of falling apart. Commodities, obviously, we're still in a downtrend. Next phase two, bonds are still going up. Stocks are also going up as well. Now we had a crash kind of come in the middle of this whole cycle, for stocks and commodities, but it also gave birth to the commodity cycle, which is phase three. Commodity cycle started. We had commodities taking off in certain ways. And another thing to think about is that there's always cycles inside of cycles, right? I could also say, this is my time frame. This is something that I would look at for my very long-term time frame. Other people might look at it and go, okay, well, maybe there was a micro cycle of bonds here, a little bit of stocks here, and a little bit of commodities here. I think it's important to understand all these different time frames, and mainly having a big time frame like this kind of really understand where you're at on a macro chart. And I can also, why these are timed this way and why these are labeled this way is also to do with the actual fundamentals underlying it. You know, were we in an economic contraction during this whole time? Kind of, yeah. You know, there was a repo market operation that had to come in to hold the market up. They were lowering rates, then they cut rates all the way to zero during COVID, gave birth to the commodity cycle as well as stocks going up. So phase three, everything is kind of moving. Bonds topped. So next part of the cycle, sell bonds, you know, but stocks, commodities kept going. Last part of the cycle, stocks start to top off, you know, the number 5, you know, sell stocks. So stocks start to top off. Number 6 is sell inflation sensitive, so commodities. So commodities start to top off and fall apart. Now it looks like, to me at least, that we're in phase 1 again. It looks like we're kind of in the phase where we're going, okay, well, bonds are kind of starting to move, stocks are kind of bottoming. Are they completely bottomed? I'm not sure, you know, but I think the highest probability trade right now is being long bonds, being long gold, possibly silver as this moves forward. And I think all of those are very viable trades at the moment. And then the next phase will probably be stocks, most likely led by something like tech, as we get into phase 2. So are we right here right now? It kind of seems like it, you know, it seems like we are in this phase 1. I drew this up. This chart's a little bit old now. You know, we're kind of up here now in the bond market. We are breaking out of this range area here. It is stronger than everything else at the moment. So, you know, bonds are looking very good. And so next chart, this is the chart of, you know, we had the yield curve, Fed funds rate, stocks, gold, stocks, gold, and then we have bonds, long-term bonds. So what I'm pointing to here is, you know, what environment, and this is important to understand, and I think this is something that, you know, no matter what type of trader you are or what you're doing in trading, it's going to be very important for you to understand what likes what, you know, like commodities, do they like yield curve inversions? You know, no. What about gold? Yes. What about bonds? Yes. It seems like it's not even that it likes it, it seems like they bottom around those times. These things happen, we start to see them bottom. As they bottom, we start to see these things kind of perk up. Can other parts of the market top during those times? Absolutely. So there's two things about it. One is a very long-term chart. And one thing people never talk about on yield curve inversions, they always talk about the crash that can happen or the recession that can happen. People don't talk about how there's usually a rally around that time. There's usually some form of a rally that kind of leads for 6 months, 8 months, and then the market usually turns over. And the other thing is there's not a ton of data points to say that it always ends in a recession. It is likely, it is very probable, is high, but there's not a ton of data points to say it always goes this way 100% no matter what. So be open to it being that's happening, be open to being in the short-term rally at the moment. But if we're going to be open to that, we also have to be open to the fact that maybe this turns out a little better than expected. Maybe this turns out a little worse than expected. You have to be open to all sides because as traders, that's what we do. Our job is not to say, hey, this is perfect forever and buy everything. It's to find out what's a good trade right now. Good trades right now to me being gold, bonds, easy trades at the moment. That's the ones that are highest probabilities to work. Things like tech stocks and things that usually do go up in that environment would be things I'd look at next. Look for those to be moving, giving buy signals, however you want to look at that. And this is the NASDAQ to bank stocks. So you'll see that, if we go back a lot further, there's times that, banks are really outperforming, but banks haven't really outperformed in a major way in a long time. So basically here we have the bank stocks to NASDAQ. We saw that they did have a little run here. They were outperforming tech. And the other thing to know, and I talked about this earlier, is that bank or NASDAQ tech stocks in general, they do well in a lot of different environments. So it's very hard to outperform tech if you're in environments that are friendly to tech. At the moment, I don't know if this is the friendliest environment to tech in the world. We'd have to see yields continue to drop. I do think that's going to happen. But it's certainly, as the yield curve is inverted, it's certainly not a good environment for banks, as we think of banks as lending businesses, banks lending, borrowing from the short end of the curve and lending from the long end of the, or getting paid back from the long end of the curve. If that inverts, that cuts into their margins, it cuts into their money. So that's putting a lot of pressure on banks. And as you see, basically this is a very, around the time of inversion is when banks started to go the other way again. And, this big breakdown from this big bank panic is something to keep an eye on at the moment. And I know everybody sees those types of crashes and they go, oh man, it's time to buy banks. They're cheap. It's time to do this. And for me, I don't think that's a really viable way of looking at things. I'd rather buy the things that are outperforming, the things that are showing relative strength. There's a lot of things to buy right now that are in good areas, value wise. Not saying they're value wise as in original value ideas of PE ratios and so on. They're value wise as in they're at zones that people are looking at, they're at levels that people are looking at, and people are interested in buying them. So I do think that the NASDAQ is for now a much better place to be than just about anything else. Next chart is emerging markets to Dow ratio. Now I usually do these to Dow. It's not because it's the broadest index, it's because I have back tested these a little bit more based on the Dow. There's more data on the Dow. So looking at, the emerging markets, we already talked about this. I switched this chart down to here because it was kind of showing where we're at. So we're going to go over this a little bit again. Basically, we're looking at emerging markets. We know, it's like I put down here, the dollar is incredibly important to emerging markets. And I said, thank you, Captain Obvious, because that's a no shit. No shit, that's important to emerging markets. So EEM is an ETF that has a lot of tech in it as well. A lot of global tech stocks, Alibaba and so on. So we're seeing that it's starting to perk up a little bit. We need to see it continue to move higher to really be interested. But if we're going, okay, well, we're looking at emerging markets to outperform. We're looking at the dollar at the moment to start to, that it topped last year, and it could continue to be the top for a little while if rates start to change. We're looking at getting out of the United States, tech, and so on, and putting these things together. Something like EEM would be a good place to put your money at the moment. Banks to gold ratio. Now, I don't know a lot of people who actually use this ratio. I've learned over the years that it is a good ratio. It tells me a lot about where I'm going to want to be in the market. It can tell me the difference between kind of a reflationary environment and a stagflation or a deflationary environment. And so you see that, the crossover basically up here, gold started to majorly outperform at that point, just about everything in the market. And then we get over to here, banks start to outperform, doing well. It's kind of showed right where banks basically bottomed. It had this, it rallied and it came up, and it's here. But, once again, I'm not trying to catch every little tick. I'm trying to catch the meat of the move. This is the meat of the move. So that was another good one. Gold had that little bounce. I think that was 2015, 16. Right where we had that kind of industrial recession, went right back up. Banks started to take off again. Then gold took off against it. Gold did really well for a while here, all the way to that recent high that it made not too long ago. And then banks took off again against gold when we had the reflationary environment, and then it went the other way again. So kind of showing that, I'm going to want to be in gold. I'm not going to want to be in the reflation trade at the moment. And here's treasury bonds, bond yields, and the yield curve as well, and gold. Once again, showing the environment that it likes. Yields kind of topping. We have the inversion of the yield curve. We're coming out of it. This is an environment that gold gets a lot of energy from. This could absolutely be a good area to be long gold, stay long gold, and also bonds, as in the long end, the short end of the curve should be coming down. The short end of the curve should be coming down faster than the long end of the curve as well. You could take a spread trade if you'd like. Meaning, being long the short end of the curve, being short the long end of the curve. There's a lot of different ways to play it at the moment. That doesn't mean that I think both of them will go lower. That's not what I'm saying. I'm saying the short end of the curve is going to go down faster than the long end of the curve, getting us back to these areas and out of a yield curve inversion. The next chart is a copper to gold ratio. I love this ratio. If anybody, doesn't use this ratio, please give it a look. Go back through it historically. It's a very good ratio to use when we're looking at yields. Each of the charts, I think, have 40 or 50-day MAs. I'm not sure. I can't read that closely on it at the moment. But basically what we're looking at here is the shape of the moving average and seeing, are we getting above or below it? At the moment, we're still holding below the moving averages, saying that gold's going to outperform copper. Most of the time, copper is kind of a global growth thing. If people are using copper, we're seeing global growth. We're seeing that there's demand somewhere. People are building, people are doing something. That's why copper will go up. If we're looking at the other way and we're seeing gold moving up against copper, that's telling me that people are looking for more of a safe haven trade. People are looking to be somewhere that has safety in it. Yields are possibly falling because of something happened globally, like at least global growth slowing. So gold will outperform copper at that point, and yields also follow this growth phase, or growth to no growth, or inflation to deflation. And it tells all of these things at the same time. I really, the indicator I use up here, everybody could see it. Basically it's above here, we're looking at yields, rising. Below here, we're looking at yields falling. And most of the time we're seeing that there's low volatility in that at the moment, as we've been very sideways for a long time. So we'll see if that makes a big move soon, one way or the other, really. But gold and copper are looking decent at the moment. That's going to change. One of them will most likely start to majorly underperform. At the moment, I think that is copper to be the underperformer. That doesn't mean it's going to go down. That just means it's going to underperform against gold. Dow's the semiconductor to Dow ratio. Semiconductor is a very risk-on part of the market. So for me, it's going to tell me that there's demand into the market. People are buying riskier and riskier assets. People are interested in tech, and at the moment, that's really apparent in this ratio. Semiconductors are, there's many different ideas of semiconductors right now. They're doing badly, they're doing great. Really, but the price is telling me right now that there is demand for them. There is investment coming into the space, and I want to be long that type of space. The whole point of being a trader is to outperform the broad market. If I can't outperform the broad market, and that's not every year, it's not going to happen every single year, but if you're trying to outperform the broad market every single year, most of the time, you're doing well. That's the point of trading. If you are underperforming the broad market, you might as well put your money in a broad market index and just let it sit there. It's two different things. So, over time, you should be outperforming the broad market. And to do that, you need to be looking at areas that are going to be stronger than the broad market. Looking at it here, right now it's tech, semiconductors as well. And also relative strength can tell us where money is flowing as opposed to what people are saying it's doing, what they're doing with their money. NASDAQ to small cap ratio. So, we saw this, really top in 2000 after the tech bubble. Tech bubble burst, boom, air comes out of the bubble, just crashes right down real hard. And then we get to 2007, 2008. Basically, this started to change the other direction. And then it really took off when the FANG craze happened, back in 2018, 2019. This really had a blow off top in 2020, right after the election, basically. Yeah, topped right after the election and started to turn over. Now it's starting to turn back up again. We might start taking out this shoulder area right here, whatever you want to call this. This isn't exactly head and shoulders, but whatever it is, rounding top. Honestly, they're all the same thing. People act like there's very special differences between flags and head and shoulders and all these things. Really, like, it's a topping pattern, it's a consolidation pattern. So we're seeing that starting to turn back up again here. Another sign that tech could be an outperformer at the moment. The DAX. So I like to also look at the DAX to see kind of, what the markets are doing. And the DAX is one that's been holding up really well. It's done really well off those October bottoms. It's getting close to new highs. There are some European indexes who hit new highs. So we need to keep watching out for this against the US, and it kind of told you early that it is outperforming. Now, most of the time, what we're looking at on these downtrends is what is outperforming when there is a downtrend. And the DAX told us there was more money going into that than other places. So as this turns back up, as this turns up and starts giving buy signals this direction, now we're going to want to be long the DAX over the S&P 500, seeing that money was flowing into it on the way down as well. Usually that leads to it being an outperformer on the way up, and it has been. Same thing with semiconductors, like it's a perfect example of this. What was the major outperformer out of the bottom in 2020? Now everybody bought everything else. Literally everybody bought everything else but tech. Tech held up well. People are always looking for the best bargain. Not a lot of people just shoved their money into tech stocks at that point, but or thought that was the area that would be an outperformer for that next year. But really, if we look at it, it barely gave anything back, in 2020 during that crash in March. And that was the place you wanted to be. That was the major outperforming area. I mean, it even outperformed basically to the end of the bull market at that point. So very interesting one there. So definitely another lesson in relative strength, as money is flowing into these areas and telling us where, it's going to be treated the best. That's where you're going to want to be. So right there, perfect example. It majorly outperformed the Dow and S&P and the NASDAQ, everything. It outperformed everything on the bottom, and it was the outperformer going forward. Very cool. Now, money looking outside of the US. So as I've talked about before, is we're kind of really going into a new phase right now, I think, for this year at least. Maybe it won't last very long, maybe it lasts 6 months. I don't know. But as a trader, being on that 4 to 6 month time frame, even a year, I'm going to want to be involved in something that's outperforming, as we're seeing. I got Greece, you got Germany, you got Spain, France. Most of Europe is outperforming over the last 6 months, basically since that October bottom. And that's actually a little bit before the October bottom. So a lot of those areas are outperforming very well. we've also got Belgium, we got Switzerland, we got Portugal, we got Greece, we got France, Italy, Spain, the United Kingdom, Denmark. So as all these are outperforming the market at the moment, Japan, we know where we want to be at the moment. Maybe it's not the United States, unless it's, we're looking at tech-based United States. That's what I'm looking at as a viable option in the United States. But other than that, I'm looking at outside of the United States for a lot of investments. This is, you can find some of these index in ETFs. You can find some of these in futures, however you trade it. But it's not saying buy all these, right now and go do that. What my point is that, look for these areas for buy signals. Be interested and open to the idea that some of these areas could be the big major outperformers this year. So model portfolio. So this isn't to say buy all these things. This is to say these are areas that I would look at in futures to be long. Some of these are already long for me. So some of these I'm interested in already. Some of these I'm not. And I'm waiting for buy signals, but there's some areas that still look good that I'm interested in that could be good areas to look at in the futures market. Model retirement long-term portfolio, however that's set up for you. This is just some ideas as well. So semiconductors being a obvious one. We talked about that before. XME has come off a bit. It's still in a hold for me at the moment, but it's looking a lot weaker than the broad market. If our thesis comes out right that bond yields are falling and it's a switching environment, some of those things like that and maybe defense could be ones that kind of fall off. Mexico, major outperformer. Taiwan, major outperformer. Germany, Sweden, major outperformers. Emerging markets. ICB, QQQ, which is the NASDAQ. Insurance, another good area to be. I think that actually hit highs. I'm not 100% sure. Somebody check on that. Defense stocks. And then obviously, gold miners, silver miners, GDX, GDXJ. There's a bunch of ETFs for that, a bunch of individual stocks, however you want to play that. I'm just giving you the macro ideas behind it. If you want to dig into any of these things, feel free. And then silver gold, that's just ETFs or whatever, however you want to hold that, physical, whatever you want to do. And not telling anybody this is not investment advice, obviously, but do whatever you want to do with the information. Steel, and it's the same thing here. These are not and Bitcoin as well. These are not, hey, go do this right now. This is just, hey, this is what I'm looking at. This is what I'm thinking. Look for buy signals in these areas as well. And so I wanted to end this on some warning signs. There's many warning signs that we could be looking for, Fed-based and fundamental-based and so on. And there's a list of those that I think everybody could make and everybody could make differently, and you should. I have my own, but also I think that because this is something that we need to talk about, which is this is a very thin rally so far. This rally isn't broad-based, and that happens a lot. It's pretty normal to see a very thin rally at the beginning of a new trend. And we also saw that the rally had a lot of participation from other areas at first. We had a lot of participation from the broad market. If you look at the RSP, which is the equal weight S&P, that ended up taking out the highs from August. And so and then making another 150-day high. So, that's looking like that was much stronger for a while. Now we have the mega cap starting to participate, which we really need to have a sustainable rally in the S&P 500, being that it's so mega cap based at the moment. So looking at that right now, seeing that's an area that is holding up the market at the moment, and definitely the NASDAQ. We need to be open to the idea of some of these stocks could possibly fall off and put major pressure on the market. 2018 is a good example of this. in 2018 we had can't remember the exact order how everything went, but I absolutely remember that we went from Netflix fell on an earnings report, Facebook fell on an earnings report, net or sorry Tesla was one of them too, Google, Amazon, and then when we're in the middle of kind of coming off and seeing some weakness in the market, Apple fell as well, and that was kind of the last domino that was holding up the market. So, and then Microsoft as well, but I think that was really just market based. It just kind of came down with everything else. So we need to really pay attention to those warning signs. Are some of these going to start falling off? Are they going to start putting out like reports that are terrible? And so if these are going to start to fall off, it's going to put pressure on the NASDAQ. It's going to put pressure on tech positions. So we really need to be open to that happening. If that does happen, that's a time to look at, if you do get long this market, if you are looking to buy some things in here, that would be a time to start shifting ideas and starting to go, okay, maybe we are headed into something nasty here. Like I said before, I have ideas, and as these start to give more and more buy signals and so on, you could be long a lot of these things. A lot of these currencies look really great already. A lot of the bonds look really great already. Gold, silver, platinum, these things look good already, but a lot of these besides that are in kind of different areas. Sugar's really good. Coffee's waiting on a buy signal again. Cattle's still holding up. Copper looks okay, not perfect, but it's okay. And Bitcoin absolutely is a long. So we're looking at these and going, okay, well, how do you structure this now that we kind of have this idea? I think simple ideas is, you wait for your buy signals, whatever that is, 100-day highs, Bollinger Band breakouts, Bollinger Band squeeze breakouts, moving average crossover, whatever you want to do. You put your stop loss in, you give it space, because the important thing to understand is you read trading books and they say, oh, well, as a trading book, you need to cut your losses short and let your winners run. Losses short, winners run. So you're sitting there every time you're down like, 0.5% and cutting your positions. That doesn't work either. You got to understand the market doesn't care about your pain. So make your positions very small. So if you do get turned on, if it does turn on your head, basically your positions should only lose about 1% of your portfolio at most. So set up your trades like that so your losses are small. And so that also means that your positions need to be small. So if you're doing something like Bitcoin, it can move about 30% pretty easily. And if you really want to hold on to a major trend in Bitcoin, your stop loss has to be at about 30%. So once again, you're not really trying to have that stop come in to get you out of your positions. You're trying to have that stop as a catastrophic, holy shit is happening. It saved my ass type of thing. And that's going to be the most important thing if you want to set this up properly. So two, that's how wide it has to be. But also, you have to understand if your portfolio is, make it an easy number, $100,000 for this hypothetical idea. That means you only want to lose $1,000. That means if you're looking at something to move like that, we're going to have a pretty small position, so to your stop needs to only be $1,000. So once again, Bitcoin is going to be a smaller position than something like maybe 2-year bonds, which are, natural movement in 2-year bonds is going to be more like 5 to 10% even at most, depending on your time frame. It can shift between both of those. Bitcoin being the major mover, which is 25 to 40%. So a smaller position in something like Bitcoin, which is very high volatility, or natural gas, another high volatility, smaller position, and bigger positions in something that are like bonds, currencies, and so on. So, all right, everybody, I hope you enjoyed this series. I really do think that at the moment we look like we're in the beginning parts of a new cycle. that obviously beginning parts of a new cycle could be very rocky. Did we go through the rockiness already, and are we on our way back up again? I don't know. That's trading. But I do know where an easy space spot to be is, and that to me is something like bonds, gold, gold. Those are the easiest places to be at the moment to make some return at the moment. And I see that a lot of money is flowing outside of the United States. So I also like a lot of these currencies outside of the United States at the moment. So keep your mind open to these things. Let's see how this turns out. And as always, I'll keep you guys updated as it changes. All right, guys, have a great weekend.